Years of hard work, savings, planning, and investment went into creating your retirement nest egg. But during times of market stress, the typical investing approaches that got you to retirement are unlikely to be the ones to safely get you through retirement. Consider the first decade of the millennium. A $500,000 retirement account from which a retiree might be taking 8% per year in withdrawals to pay expenses would have produced a vastly different retirement depending upon how the nest egg was invested. Out of the gate, the bursting of the tech bubble would have reduced the value of a buy and hold 60-40 stock bond portfolio by about 36%, net your withdrawals and a 1% advisory fee. But a risk-managed tactical approach with net of a 1.5% fee would have accommodated your withdrawals and supported the ongoing account value. This would have been followed by about 4 years of rising markets which supported your withdrawals, fees, and account balance. When the great financial crisis hit, the difference between a buy and hold diversified approach and active management would probably have been the difference between sleeping or not sleeping well at night. By the end of the decade, an 8% withdrawal rate from the 60-40 account would give you about $1,700 a month to live on and have depleted half your nest egg, while the managed risk approach would be paying out over $4,000 a month from a nest egg that grew by about 25%. But wait, when you originally set a withdrawal rate of 8% on a $500,000, it was because you needed $3,333 a month to live on. Then there's inflation on your expenses over time. This reality exposes the difference between a secure retirement and possibly going broke in old age. These examples are based upon the actual performance of the S&P 500, the aggregate U.S. bond market, and the managed risk strategy employed by Trendhaven. So here we are in June of 2022, and it's been 14 years since the last major market correction. There's a war going on in Europe, a slowdown in China. We're entering a period that looks a lot like stagflation. Central banks are raising interest rates into a recession. The S&P 500 is down 21% from its January high. The corporate bond market has dropped 25%. And real estate indexes are down 20 to 25%, and this may just be the beginning. Retirees who are paying attention may feel as if the anxiety race has just begun. Don't let your financial advisor convince you to take on more risk to bridge your retirement funding gap, while there are safer alternatives. As you navigate investing during your retirement years, remember, a 6-foot-tall man can drown while crossing a stream that is, on average, only 1 foot deep. Contact Trendhaven to learn more about a safe, liquid, risk-managed separate account with custody at Wells Fargo.